Calm, reflective documentary narration, low energy, deep voice, slow pacing, empathetic tone. Linda's grandmother gave her $10,000 when she graduated from college in 2014. For Linda, it was an enormous amount of money, more than she had ever seen sitting in one place. It felt heavy, important, almost sacred. Her grandmother had worked her entire life, lived through recessions, wars, and uncertainty, and this gift carried more than just dollars. It carried advice. She told Linda to be careful, to put the money somewhere safe, not to gamble it in the stock market, not to chase returns, just to protect it, save it for emergencies, maybe a down payment someday, something sensible, something responsible. Linda listened. She did exactly what she was told. She opened a savings account at her local bank, the same bank her grandmother had trusted for more than 50 years. It felt right, familiar, solid. She deposited the $10,000 and felt a quiet sense of relief. The money was no longer exposed to temptation. It was no longer something she could accidentally spend. It was locked away, guarded by the reputation of a big institution and the comforting word insured. Every now and then, Linda checked the account. She watched the balance creep upward by a few dollars each year. The interest rate was almost nothing, about 0.06% annually, but that didn't bother her. The goal was not growth. The goal was safety. The number never went down. The balance stayed steady. That stability felt like proof that she was doing the right thing. For 10 years, she barely touched the money. She felt prudent, mature, like someone who had their financial life under control. Then, in 2024, Linda decided to buy a used car. Nothing fancy, just something reliable. She went to a dealership and found a Honda Civic that fit her needs. As she sat down to talk numbers, she assumed her savings would cover most of the cost, just like it would have years ago. The car was priced at $22,000. That surprised her. A decade earlier, the same model, in the same condition, with similar mileage, would have cost around $14,000. Linda pulled up her savings account balance, $10,063. 10 years of interest had added $63 to her grandmother's gift. She stared at the screen and did the math slowly, almost in disbelief. The money that once nearly covered the car now fell short by more than $12,000. Nothing had gone wrong. She hadn't spent the money. She hadn't made a bad investment. The number was still there. But something felt deeply off. Sitting there, she realized something she had never been forced to confront before. Her money had not been resting safely for 10 years. It had been quietly shrinking, not in appearance, but in power. The world around it had become more expensive, while her savings stood still. The value she thought she was preserving had been slipping away the entire time. By doing nothing, she had lost nearly a third of what that gift could actually buy. That was the moment the illusion broke. The realization didn't come with flashing warnings or dramatic losses. It came with a simple comparison. The same car, the same money, a completely different outcome. Her savings had not protected her future. They had slowly eroded it right in front of her, without ever looking dangerous. What Linda experienced in that moment is something almost no one is taught to recognize. She believed her money was safe because the number never went down. The balance stayed the same. There were no red alerts, no warnings, no visible damage. But safety, as it turns out, has two very different meanings. There is nominal safety, where the number on the screen does not shrink, and there is real safety, where the money retains its ability to buy things in the real world. Linda had the first kind. She did not have the second. This is where most people misunderstand what money actually is. We're trained to think of money as a fixed unit, a stable thing, like inches or pounds. $10,000 feels like $10,000 forever. But money is not a unit of value. It is a unit of purchasing power.
and purchasing power is never stable. It is constantly changing, slowly and relentlessly, through inflation. Prices rise, goods cost more, services become more expensive, and every dollar you hold quietly loses a piece of what it can do. Between 2014 and 2024, cumulative inflation in the United States was roughly 31%. That means something that cost $100 in 2014 cost about $131 10 years later. Flipped around, $1 in 2024 only bought what about 76 cents could buy in 2014. Linda's $10,000 had not stayed whole. In real terms, it was now worth closer to $7,600 in the world she actually lived in. This loss did not feel like a loss because nothing visible happened, no transaction occurred, no mistake was made, no bad decision showed up on a statement, yet the damage was very real. Linda had effectively lost nearly $2,400 in purchasing power simply by leaving the money untouched, not by taking risk, not by gambling, not by doing something reckless, but by doing nothing at all. This is the core of what can be called the savings account illusion. The illusion works because inflation does its damage silently. It does not announce itself, it does not send notifications, it does not show up as a negative number. It just slowly widens the gap between what your money says it's worth and what it can actually buy. Over time, that gap becomes enormous. Savings accounts are often framed as protective, as conservative, as the responsible alternative to investing. But when the interest rate on your savings is far below the inflation rate, the account is not protecting your wealth, it is guaranteeing its decline. You are not earning a small return, you are locking in a slow, predictable loss every single year. Linda's money did not fail because the bank collapsed or because the market crashed. It failed because the environment changed around it while the money stayed still. The balance remained frozen while prices marched forward. What looked like stability was actually stagnation, and stagnation in an inflationary world is decay. This is why the most dangerous part of the savings account illusion is not ignorance, it is comfort. The comfort of seeing a number that never goes down. The comfort of believing.
To understand why avoiding risk is the same thing as being safe, the comfort of thinking that time is on your side when, in reality, time is working against idle cash. To understand why this illusion is so powerful, you have to look at how the human brain reacts to loss. We are wired to fear what we can see. When a number drops, when a balance shrinks, when something visibly disappears, our nervous system reacts immediately. Stress rises, fear kicks in. The instinct to stop the pain takes over. This is why stock market downturns feel so terrifying, even when they are temporary. The loss is loud, it demands attention. Invisible losses do not trigger the same response. When the number stays the same, the brain relaxes. There is no urgency, no alarm. Even if the real value is slipping away, it does not feel like danger. Behavioral economists call this loss aversion. We feel the pain of visible losses far more intensely than the damage caused by invisible ones. The savings account exploits this bias perfectly. It hides loss behind stability. Imagine two people. One invests $100,000 in the stock market. During a downturn, their portfolio drops to $85,000. They feel sick. They feel like they have lost $15,000, even if the market later recovers. Another person keeps $100,000 in a savings account. 10 years pass, the balance is still $100,000. Inflation, however, has reduced its purchasing power to the equivalent of $85,000. The outcome is the same. $15,000 of real value is gone. The difference is that only one person feels it. This psychological gap changes behavior in dangerous ways. Market losses often cause panic selling, but they also force engagement. People pay attention, they learn, they adjust.
Savings account losses cause complacency. People feel responsible, so they stop questioning their strategy. Years pass, decades pass. The damage compounds quietly, without ever provoking action. What makes this even more unsettling is that the system benefits from this passivity. While Linda's money sat in her savings account, the bank was not simply storing it. Banks do not make money by holding cash, they make money by using it. Deposits are lent out as mortgages, business loans, auto loans, and credit card balances. While Linda earned $6 a year, the bank was earning many times that by lending her money at rates far higher than what they paid her. On average, banks earn a net interest margin of around 3%. That spread is the difference between what they pay depositors and what they earn on loans. On Linda's $10,000, the bank earned roughly $300 per year. Over 10 years, that adds up to about $3,000. During the same period, Linda lost roughly $2,400 in purchasing power. Her caution helped fund the bank's profits, while her own wealth quietly deteriorated. This is not fraud. It is not a hidden scheme. It is simply how the banking system works. The system relies on the fact that most people never measure money in real terms. They see stability and assume safety. They trust that doing nothing cannot hurt them. In reality, their inaction is exactly what allows the erosion to continue uninterrupted. The cruel irony is that the place that feels safest is often the place where loss is guaranteed. Not all at once, not dramatically, but slowly enough that it feels normal. Slowly enough that it never feels like a crisis, until one day, like Linda, you are forced to compare what your money was supposed to do with what it can actually do now. At this point, many people push back with what sounds like a reasonable defense. A savings account may lose purchasing power, they say, but at least it cannot crash. Stocks can fall, markets can panic, investments can go down by 20 or 30% in a single year. A savings account never does that. This argument feels logical, but it rests on a dangerous confusion between short-term volatility and long-term risk. Volatility is movement. Risk is permanent loss of purchasing power. The stock market is volatile, meaning prices move up and down, sometimes violently. But over long periods of time, diversified equity markets have consistently grown faster than inflation. A savings account, by contrast, is stable in appearance, but unstable in reality. Its value never moves, while the world moves away from it. That stability is what makes it so deceptive. Over the past century, the S&P 500 has returned roughly 10% per year before inflation. After adjusting for inflation, the real return has been around 6 to 7%. That difference compounds dramatically over time. Savings accounts, on the other hand, have historically paid less than 1% on average. In real terms, that means they have destroyed purchasing power for most of modern history. This creates a paradox that feels uncomfortable to accept. The option that feels risky is often the option that protects and grows wealth over time. The option that feels safe is often the one that guarantees slow loss. The danger is not that markets fluctuate. The danger is that inflation is relentless. Markets go up and down. Inflation mostly goes in one direction. High-yield savings accounts complicate this picture, and it's important to address them honestly. When interest rates are high, these accounts can offer 4 or 5% returns. In an environment where inflation is closer to 3 or 4%, that can result in a small positive real return. This is meaningfully better than traditional savings accounts and absolutely preferable for holding cash. But high-yield rates are not permanent. They exist because central banks raise rates to fight inflation. When inflation falls, rates fall with it. Over time, those attractive yields shrink back toward 1 or 2%, and the real return turns negative again. A high-yield savings account is an improvement, not a solution. It reduces the damage, but it does not eliminate the underlying problem. Even at their best, savings accounts dramatically underperform productive assets over long periods. An investment growing at 8% above inflation will double purchasing power roughly every 9 years. An account growing at 1 to 2% above inflation takes several decades to do the same. Over a lifetime, that difference is not incremental, it is transformational. The real mistake is treating cash as a destination instead of a tool. Cash has a purpose. It provides liquidity. It absorbs shocks. It prevents forced selling during bad times. But cash is
Calm, reflective, documentary narration, low energy, deep voice, slow pacing, empathetic tone. Not designed to build wealth. Holding it for long-term growth is like using a lifeboat as a cruise ship. It keeps you afloat, but it does not take you anywhere. The longer money sits in a savings account beyond its intended role, the more opportunity cost accumulates. That cost is not just the interest you did not earn, it is the compounding growth you never captured. Year after year, that missed growth becomes a gap that cannot be closed later without taking far greater risks. Once you see the problem clearly, the next question becomes unavoidable. If savings accounts slowly erode wealth, what should cash actually be used for? The answer is not to eliminate cash entirely, but to put it back into its proper role. Cash is not an investment, it is insurance. It exists to protect you from short-term uncertainty, not to secure long-term growth. There are only a few situations where holding cash makes sense. The first is an emergency fund, money that must be available immediately, without risk, without delay, and without dependence on market conditions. This is the buffer that allows you to handle job loss, medical expenses, or unexpected repairs without panic. For this purpose, stability matters more than return. The second use for cash is short-term goals. If you plan to buy a car, pay for a wedding, or make a major purchase within the next 1 or 2 years, that money should not be exposed to market volatility. The time horizon is too short to recover from downturns. In these cases, preserving nominal value is appropriate, even if real returns are modest. For both of these uses, a high-yield savings account is the correct tool. It minimizes erosion while keeping funds accessible. But the key is limitation. Cash should be held deliberately and in measured amounts. Anything beyond what you actually need for emergencies and near-term spending becomes excess cash, and excess cash is where the illusion turns dangerous. Every dollar held beyond necessity carries an invisible cost. That cost is not theoretical. It is the compounded growth you give up by not allowing your money to work. Over years and decades, that lost compounding dwarfs the original balance. What feels like patience is often just stagnation disguised as discipline. A simple framework brings clarity. Start by calculating your true monthly expenses, not your income, but what you actually spend to survive. Housing, food, transportation, insurance, and other non-negotiables. Multiply that number by 6. That is your baseline. Not a guess, not a feeling, a number. Write it down and treat it as fixed. The second action is to separate safety money from growth money. Once your emergency fund and short-term needs are fully covered, anything beyond that is no longer serving a protective function. It is simply sitting idle. That idle money should be moved deliberately into a brokerage account and invested in low-cost, diversified index funds. This step feels uncomfortable because it replaces visible stability with visible movement, but it is the only way to escape guaranteed loss. For most people, simplicity is a strength.
Broad market index funds provide instant diversification, extremely low fees, and exposure to long-term economic growth. They do not require constant monitoring or complex decision-making. Their power comes from time, not timing. The longer the money stays invested, the more the compounding works in your favor. The third action is to optimize the cash you do keep. If your emergency fund is sitting in a traditional savings account earning almost nothing, you're accepting unnecessary erosion. Moving that money to a high-yield savings account can be done in less than an hour and immediately reduces the silent loss. This does not change your risk profile. It simply stops you from bleeding faster than necessary. The fourth action is automation. This is where most people fail, not because they lack knowledge, but because they rely on willpower. Set up automatic transfers from your checking account to your investment account. Set them to occur shortly after you are paid. Let the money move before you have time to second-guess it. Automation removes emotion, hesitation, and procrastination from the process. At this point, many people feel a shift in identity. They no longer see themselves as cautious savers, but reckless risk-takers. This discomfort is normal. It comes from confusing movement with danger. Investing does not mean gambling. It means accepting short-term uncertainty in exchange for long-term preservation of purchasing power.
Keeping excess cash is not avoiding risk. It is choosing a different risk, a quieter one, a guaranteed one. Inflation does not fluctuate the way markets do. It advances steadily. Every year you delay action, the cost compounds. Not dramatically, not loudly, but relentlessly. The savings account illusion survives because it feels responsible. It flatters your fear of loss and rewards inaction with comfort. Breaking free requires you to stop judging safety by how calm it feels and start judging it by what your money can actually do in the future. When you see safety in real terms, not nominal ones, the illusion loses its power. At the end of this, the question is no longer whether savings accounts are good or bad. The question is whether you understand what they are actually doing to your money. Most people believe they are protecting themselves by keeping cash. In reality, they are protecting a number, not a future. The number stays the same. The future gets smaller. The most dangerous part of the savings account illusion is that it rewards passivity. It makes you feel virtuous for waiting. It convinces you that patience without participation is wisdom. Over time, this belief hardens into identity. You become someone who is good with money because you avoid visible risk. Meanwhile, invisible risk compounds quietly in the background. Inflation does not care about your intentions. It does not care that you worked hard for your savings or that you were trying to be responsible. It only responds to time. Every year that passes without your money growing faster than prices is a year where your purchasing power shrinks. This is not a possibility. It is a mathematical certainty. The stock market is unpredictable in the short term, but inflation is predictable in the long term. Markets may scare you with sudden drops, but they also recover and grow. Inflation never gives back what it takes. It only asks for more. When you hold excess cash, you are not standing still. You are moving backward at a slow, almost invisible pace. True financial safety is not about avoiding movement. It is about aligning your money with reality. Reality is that prices rise. Reality is that productive assets grow. Reality is that doing nothing is still a choice, and often the most expensive one. Once you accept this, the fear begins to change shape. You stop fearing volatility and start fearing stagnation.
The escape from the savings account illusion is not dramatic. It does not require bold predictions or perfect timing. It requires clarity. Clarity about what money is, what it does, and what happens when it is left idle in an inflationary world. When you measure wealth by what it can buy rather than what it says on a screen, your decisions begin to shift naturally. Keeping money in savings feels safe because the loss is hidden. Investing feels dangerous because the movement is visible. But safety is not about comfort, it is about outcomes. And over time, the outcome of excess cash is guaranteed erosion, while the outcome of disciplined long-term investing has historically been growth. Once you see this clearly, you cannot unsee it. Every balance check becomes a question not of how much you have, but of how much it can still do. At that point, the illusion breaks completely. What remains is responsibility of a different kind. Not the responsibility to avoid risk at all costs, but the responsibility to choose which risks you are willing to live with.